In this video, I'm going to go through some key aspects to the CIMA P1 exam. It is not going to be a detailed report, it is going to be a brief overview of some of the most commonly asked questions and of the most common topics you may get asked about. So to begin with, we're going to have a refresh on marginal costing. Remember that marginal costing is where all variable costs will be included in the cost of sales figure. There are absolutely no fixed costs involved when it comes to marginal costing. Fixed production overheads are never going to be absorbed under a marginal costing approach. It is a quick and easy method for this reason, and it is not very time consuming. It is very good if there is high variable selling and distribution costs with no production costs. So marginal costing is good for a service-based business. What are the benefits then of marginal costing? Well, contribution per unit is constant over different sales volumes. There's going to be no over or under absorption of overheads. It is going to highlight that contribution is so appropriate when it comes to decision making. We want to make those products with those highest contributions being earned. Your profit is going to depend on your sales and efficiency levels as opposed to your production levels, and it is very simple to operate. Now, of course, for everything that has advantages, they also have drawbacks. So what are some of the issues then with marginal costing? Well, if we are just focusing on contribution, it may not necessarily cover all of our fixed costs. It also does not comply with International Accounting Standard 2 when it comes to valuing inventory. And point 3 is that our fixed production overheads are never going to be shared between our units of production, but instead they are going to be written off in full. Marginal costing is obviously one option. On the other hand, we've got absorption costing, which is a more traditional approach if we're being honest. So with this, all production costs are going to be included in your cost of sales, whether they are fixed or variable. But be careful, because any selling and distribution costs are not going to be included in that cost of sales figure. So all production costs and only production costs are going to be absorbed. It is good where there is high production levels in a business, and it is very useful for when it comes to setting prices because of this. Now, obviously, there's a little bit more to absorption costing than marginal, so it is more complicated and it is more time consuming when we come to use this one. It is also, when we come to apply machine or labour hours, it can be quite arbitrary in the sense that we need to allocate our resources out. Well then, what are the benefits of using this? Well, it complies directly with IAS 2 in terms of inventory counts. It also would give a business better cost control due to analysing that under or over absorption of overheads. And it also recognises that the selling price must cover all costs, not just variable costs. We need our fixed costs to be covered as well before we can begin to make a profit. Disadvantages of it? Well, profits can easily be manipulated by changing our production levels, and it is of course based on the assumption that overheads are volume related, and we have already covered the fact that it can be complex to use and that it is more time consuming than that of marginal costing. So when it comes to calculating our profit or loss will always give a different figure when we use marginal and absorption costing. This is the difference in inventory which is causing this to happen. It ultimately means that if there is an increase in inventory, there is going to be an increased profit for absorption, thus a decrease in inventory, a decreased profit for absorption. Your absorption profit is going to be equal to your increase in inventory multiplied by your fixed overhead absorption rate, which will then give you your marginal profit. Activity-based costing then. Remember, with this, it is a form of absorption costing, but it takes it to the next level. So overhead cost pools are going to be apportioned based on appropriate activities. There are going to be group-related costs into a pool, for example, electricity, or perhaps repairs and maintenance. It is going to establish the cost driver for each level of cost. So that could be measured based on square foot of each production department, for example. We then have to calculate the cost per unit of that cost driver. And at that point, we are able to absorb our activity cost. Well, what are the benefits of this? Well, it's going to be more accurate than overhead absorption because ultimately we are allocating things out more accurately and they're going into each individual category. It's more meaningful, particularly when offering different services. That should allow you to have better cost control. Reducing your costs will mean that you have more profit as well as more cash. There is going to be decision making within product mixes happening. It's going to allow you to set more accurate and more reasonable sales prices. So pricing and viability of all flavours of all products are going to be available, ensuring that enough margin is made. This is especially true with new products entering the market because you perhaps don't know how accurately to price them with a normal absorption costing method. Understanding costs then. Well, this is the process of investigating costs, and what drives them helps us to understand these costs better, and therefore we are able to identify potential cost reductions. As always, we have some drawbacks to this as well. So it's going to be of limited benefit if the overhead costs are primarily volume related, or if the overhead is a very small proportion of the overall cost. It's probably not worth your time to do it if that is the case. It's impossible to be able to allocate all overhead costs to specific activities. Some are going to range over a number. The choice of both activities and cost drivers may be inappropriate for your business. And also, this can be very complex to explain when it comes to informing your stakeholders of this costing exercise that you have done and that you are using in the business. The benefits obtained from ABC may not justify the cost. This is going to cost a business a heck of a lot more in comparison to absorption costing or marginal costing. You may find that other systems also need to be changed. For example, the way in which a business calculates their variances. The next little thing to look at then is throughput accounting. So this is calculated by doing our sales less our cost of sales. This sounds familiar, but throughput accounting takes this one step further. Our cost of sales in this scenario is only going to be our value of our raw materials. So essentially it is our sales less our direct materials. All of the costs are going to be classed as operating expenses or conversion costs. These are going to come after our contribution line. In throughput accounting, inventory is valued at the purchase price. The concept is that it does not create a profit until there is a demand for that product. What is the throughput concept then? Well, the theory on constraints is a production system which is the key concept to maximize throughput from the direct material to the sale. So, in order to do this then, we firstly must identify the constraint or the bottleneck. This could be things like machine hours, labour hours. It may even be the number of direct materials the amount of kilograms of that material we have available to us. We then have to exploit the highest possible outcome from that bottleneck resource. This is going to be the time in which we limit the process before the bottleneck to work to the same speed to avoid any buildup. And finally, then, we take the steps that we need in order to improve the production efficiency. This system is going to be continuously revised and continuously repeated up until we are satisfied that our bottlenecks are in the best production line for us. It is an appropriate system to apply when a just-in-time attitude is adopted, and that is important to remember. Inventory levels are going to be minimal. They do not create any profit. Another thing businesses use then is ratios in order to evaluate their production. So we have a return per factory hour, a cost per factory hour, which will give us our throughput accounting ratio when one is divided by the other. So our return per factory hour is going to be our throughput contribution per unit divided by our product time on our bottleneck per unit. Our cost per factory hour is our total factory cost, our operating expenses, divided by our total time on our bottleneck taken. This can then find our TP accounting ratio by doing our return per factory hour divided by our cost per factory hour. If you get a ratio that is greater than 1 for the product, that means it is a viable product to be made. Anything less than 1, probably not worth it. Products with the best throughput accounting ratio should always be given priority. Benefits of these ratios then. Well, firstly, the product mix is able to be optimized by maximizing the throughput contribution per hour or per kilogram or whatever it may be. Similar to limited and factor analysis, we are able to determine an optimal production plan from this. It is going to highlight in management and gather focus on a bottleneck in order to alleviate any pressures the business may have. So, it could additionally highlight which production processes not to waste resources on as well, but it's also going to tell you where your resources should be focused. So the processes prior to the bottleneck are also going to be examined under throughput, and production is going to be limited, as well as costs being reduced. So, moving on to relevant cost. What is a relevant cost? Well, it is either a go or a no-go decision. It is going to differ from our financial accounting treatment, so it is not going to include things like depreciation, provisions for doubtful debts. It is a future decision. It cannot be a cost that we have already made. We have already paid. The bill is settled. It is not something that has been a sunk cost or a committed cost. If I have already committed to make that payment, that is not a relevant cost. That decision has already been made. There's nothing I can do about it. A relevant cost can be incremental. It can be an additional cost to something because I have not yet made that payment. And it is a cash flow. It is not going to be involved in our P&L statement. So things like depreciation aren't going to be relevant. Staffing, additional or opportunity costs are going to be relevant costs. Beyond budgeting principles then, what are these? Well, it's a wider range of performance measurements which are used. So for example, customer satisfaction levels. Targets are often going to be set based on benchmarks which are observed on an external basis. And in this area, innovation is strongly encouraged and will actually be rewarded. We're going to have a little look at risk now. So expected value, what do I mean by that? Well, an expected value is a weighted average of all possible outcomes. It calculates the average return that is going to be made if a decision is to be repeated. It is contained and obtained by multiplying the value of each possible outcome by the probability of that outcome and summarising the results. The formula for the expected value can be seen on screen, but essentially that is just multiplying our probability of the outcome by the value of each possible outcome. This is a risk-neutral approach to decision making. The higher the expected value, the higher the risk. The lower the expected value, the lower the risk. Perfect information then, something that you may or may not be familiar with, but just a key calculation to remember. Our expected value with perfect information less our expected value without perfect information is the value of perfect information. And remember, our value of perfect information will never be a minus figure, simply because if we had perfect information, our expected value would be fantastic. It would be the highest it can be. Without perfect information, we are going to be a little bit lower. We're taking that lower risk and perhaps not getting the best outcome from the scenario. Sensitivity analysis. So for this, we can do our profit divided by our cost or our sales, and we multiply this by 100%. So the percentage change would result in a loss. Change one variable at a time when doing this, and it ignores the interdependence of some variables. So a lot of businesses perhaps find this time-consuming and perhaps not very helpful. However, it is very simple to do. It's a few easy calculations. What if analysis then? Well, this is going to point out what is in fact happening if we change something. So revenue may increase, for example, if the selling price is reduced, but more units are going to be sold. Or perhaps our variable costs would increase by the same proportion as our increase in volume. Maybe our fixed costs are just going to remain constant no matter what happens. Or could it be that our fixed costs are actually going to take steps when we produce more units? These are all questions that a business needs to ask themselves. And remember, our what-if analysis is never going to be a perfect scenario. It is always going to be based on assumption. We can see the impact of multiple variables changing though, which is always a good thing. And it is still very simple for a business to use. You do not need to be a genius to do a what-if analysis. We are now going to move on to the actual different strategies when it comes to calculating risks. So the first approach is the maxi-min approach. So for this, we are going to choose the higher option of the minimum return each option could give. The maxi-min approach is that of a risk-averse person. Maxi-max, on the other hand, we're going to choose the higher option of the maximum return each option could give, and this is a risk-seeking approach. Minimax regret. We are going to consider the maximum return for each outcome and the worst regret for each option, choosing the lesser of the worst potential loss. This is another risk-neutral approach. Decision trees then, something that you're probably already quite familiar with by now. So, these offer a visual representation of potential outcomes and the decisions that would lead to those in the sequence. When calculating these then, it should be worked from left to right. It's almost as if we are working backwards. But when it comes to you making the decisions at the end, we are going to work in our logical approach and we're going to work right to left. Decision points. So if you have a square, these are going to be the representation of the best outcome and continue. Any circles are just going to indicate a calculation. Evaluating the tree then, well, the best outcome is the option that you want. There are some issues with decision trees. First of all, they are very dependent on probability estimates, and these can sometimes be based on opinions, so it can be a very biased tool. There are a very limited number of outcomes, and it assumes outcomes are possible. It is an expected value limitation as well. Remember, decision trees and expected value, they are giving risk-neutral positions. Certainty of outcomes. So there's no way that decision trees may well be certain. Time series analysis, what do I mean by this? Well, we have our actual data, which is our past data of sales per period. We have our trend, which is our long-term movement in sales. These have already happened. But when we talk about our trend line, we exclude any seasonal variations that may happen. Seasonal variation then, I've just mentioned it, but what is it? Well, essentially it's the impact of the seasonality on sales. It speaks volumes, it speaks for itself. Think about Easter eggs. They're much more popular at Easter than what they are at Christmas. I'm more likely to buy a Cadbury's cream egg Easter Sunday than Christmas Day. Christmas Day, I want my Secret Santa selection box, not a cream egg. Cyclical variation. Well, we've got the cycle of the recession in the wider economy, sorry. It could be a cycle of a boom in the economic process. We have random variation. So this is any outliers. This is basically variants that do not fit our trend and do not fit in our data, but sit far outside the curve. You can work this out by doing your seasonal variation and or your X trend. Linear regression then. Well, this models the behavior of the trend, and the fixed element is the starting amount. So for example, I've got 2,000 protein bars. That is what I am starting with. The variable element is the period number by the period increase in the trend. Perhaps every quarter I expect to receive an extra 100. So next quarter, I change that to say 2,100. So when we talk about time series analysis then, we have two methods that we can use, two models. We have the additive model and we have the multiplicative model. It's not difficult to see why they're called what they're called. The additive is when the elements are independent of each other, and essentially we add them to our basic line of trend. The multiplicative model, however, is when we multiply. That trend is rising rapidly to show too that seasonal variation, it will increase in proportion to the sales. But what are the problems with using this analysis? Because it seems quite simple to me. Well, it's assumed. Reasons for variations. I just gave a good example of Cadbury's cream eggs at Easter. We're starting to see at Halloween gooey eggs, I think they are, or goo heads, which is a version of the cream eggs by Cadbury. They are in line with that marketing tool. That product is technically the same, but just got a positive spin on it for Halloween. Are we now starting to see that trend? It's got a limited set of data points, and it assumes that linear regression is happening. Well, that's not always the case. And also, can we rely on the past to predict the future? I don't think we can. As we move through the generations, things are changing. Technology is growing rapidly, making us think differently, but also change our behaviours in the way that we buy as consumers from retailers. Optimal production plan graph points then, something to bear in mind with linear regression. We have our feasible region. Well, this is the area on the graph where all constraints, such as limited resources, labour, materials, etc., are going to be satisfied. Any point within this region is going to represent a production plan that is possible given those available resources. We then have our constraints area. So this is going to be the limit on production. It is going to be shown as lines on the graph. And each constraint, like budget limits, material availability, whatever it may be, divides this graph into the possible and impossible areas. We then move on to the ISO contribution line. So this line is going to represent a combination of products that are going to generate the same profit or contribution levels. As we move to those higher ISO contribution lines away from the origin, that means our profit is going to be higher. And then lastly, we have our optimal point. So this is the point in the feasible region where the highest ISO contribution line is going to touch. This will represent the production plan that maximises profit whilst respecting all constraints available. Moving on then to break even. Well, I've got a break even graph on the left-hand side of the screen there for you all to see. So break even is where the revenue starts to outweigh the costs. It is the point at which neither a loss nor a profit is being made. But in order to calculate this, there are two methods. If we want to calculate our break even in units, we do our fixed costs divided by our contribution per unit. But if we want our break even in revenue, we do our fixed costs divided by our contribution to sales ratio, which I will talk a little bit about in a moment. So, like I just said, break even is the number of products that we would have to sell where we aren't making a profit and we're not making a loss, but our costs are equal to our revenues. CS ratio then. Well, I've just briefly mentioned it. It is calculated by doing our contribution divided by our selling price. But what does it mean? Well, essentially it tells us how much of revenue contributes to our costs. The closer that this is to 1, the better. It can be used to find the break-even point, the margin of safety, the target profit, as well as to rank products when it comes to deciding which product to prioritise. Margin of safety. Well, what is it? Well, all sales above the break-even point are going to bring in a profit for us. This region, which we know as the margin of safety, is going to be between the break-even sales and the budgeted level of sales or current level of sales, as we may refer it to, which is how much the budgeted sales, current sales level, can actually fall by before the business actually begins to make a loss. This can then be added to the target profit. So in order to calculate our margin of safety then, we do our current sales level, deduct our break-even sales, and that will give us our MOS. If we want to calculate this as a percentage, and you may well be asked to do so, you need to do your current sales level minus your break-even sales divided by your current sales level multiplied by 100. Target profit then. Well, the target profit is going to be how much over breaking even we would actually want to make. Most business owners are going to have a target to which they want to achieve within that financial year. With this information, we can then add this to the fixed costs to calculate the minimum number of sales units that we need to actually make in order to break even, as well as make that profit. So we just do our fixed costs plus our target profit divided by our contribution per unit. If instead we want to do that in terms of a sales revenue point of view, we do exactly the same calculation, but instead this time we are going to divide once again by our contribution to sales ratio. This is going to be used to calculate the sales revenue per unit's target. The cost transformation model, something that is of great use. So I'll very quickly run through this. I'm not going into it in any great depth, so you may need to refresh yourself with this one. Number 1 is to endanger a cost-conscious culture. Focusing too much on transformation without balancing costs is going to be a risk losing a focus on cost efficiency. Generating max value then. We ensure that the transformation process creates the greatest possible value from resources and activities. Driving efficiency is all about streamlining processes to minimize waste and optimize our use of resources for better output. Balancing short and long-term goals. So this is all about aligning immediate operational needs with long-term strategic objectives to sustain growth and to make sure the business continues. Aligning stakeholder interests. Well, we need to ensure that all of our stakeholders, whether it be customers, managers, or just the local community, are happy. We need to make sure that they are going to benefit from our transformation. We also need to foster innovation. We can't just be a business that just sits and does the bog standard copycat of what every other business is doing. We instead need to encourage creativity as well as new ideas within the transformation process if we are going to stay competitive. Remember, a competitive advantage is key to our success. Controllable variances then. What are these? Well, these have the power to affect change. So wastage due to lack of staff training, for example, it is within our power to train our staff. This could lead to better efficiency variances, but also higher levels of productivity. We could prevent wastage due to a lack of preventative or conformance quality checks. So if we aren't doing enough quality checks, perhaps we aren't being upfront with our staff because we don't know about it. Perhaps we need them to do a better job. Efficiency due to a lack of staff motivation. Well, again, if they're not motivated, they're probably not working at their best capacity. However, that is something we can change. Breakdowns due to lack of preventative maintenance. Things like getting machines checked and serviced annually, biannually, is going to help those machines from breaking down, not meaning that production has to stop. However, there are also uncontrollable variances. There are things that we can't prevent. So what are these? These are unplanned. We have no power in these sort of things. Things like our supplier increasing prices. We can't do anything about that. We've just got to pay them, or we find an alternative supplier. Chances are one supplier's put prices up, so is everyone. If we've got maintenance breakdown due to the age of our machinery, perhaps we weren't going to know that it was going to do that. The only way we could control this is by going out and buying new machines, which this is obviously going to be quite costly. Committed costs, perhaps it's not down to our department, those committed costs. Perhaps it's an apportionment of overhead fixed costs. We can't stop that. That is out of our department's control. And like I just said, apportioned overheads, similar sort of theory as to committed costs. Sales quantity variance then, well, this can be calculated by doing your actual quantity sold less your budgeted quantity sold multiplied by your standard price. How do we calculate it then in a multi-product environment? Well, firstly, we would have to work out the variance between the budgeted or standard units in a standard mix and the actual quantity of units sold and split across the standard mix. These would then be the unit figures multiplied by the profit per unit in order to equal that quantity variance. This is only appropriate to use when you want to measure the sales variance in broad terms across a product range. It is by no means accurate to one product. It would not be appropriate if you are considering perhaps ending a product line or seeing which products have a detrimental impact on that profit or loss statement. Sales mix variance then. This again is going to be calculated in stages. So firstly, you take the actual sales of each product in the budget or standard mix, and then your variance in units from the above to the actual units of each product sold. You would then value the difference by multiplying by the budgeted profit for each product. When using this variance, it is appropriate for determining the types of products which have been sold. You need to consider, has this had a positive or a negative impact on that profit or loss, rather than the volume of sales? Sales price volume then. So this is our actual unit price, less our budgeted unit price multiplied by our actual quantity. So we have sold our products at a higher or lower price than budgeted. This however, does need to be further analysed. You cannot rely on this calculation on its own. You need to assess how the variance is broken down by product type. Labour rate variance. This is essentially the difference in how much we have paid our staff compared to how much we had budgeted to pay our staff. So if we think about reasons why this could be the case, perhaps we overpaid our staff because we've had to get agency staff in. They cost a little bit more than our standard staff who are perhaps running sick for whatever reason. Or it could be due to, if the labour rate variance is favourable, it might be because we've employed junior staff. We can pay them less, they're not as experienced. And the national minimum wage is obviously going to be lower for those younger age ranges, although Labour are perhaps set to change that in the coming years. Labour efficiency variance then. Well, this is going to tell us how productive our workforce have been. So we are comparing our actual production of our workforce in comparison to our budgeted production. This is going to show us the appropriate number of hours that were or weren't used. An example could be our labour efficiency is favourable due to staff trying to make up lost time from the breakdown, but it could also be adverse. One example of that is if your staff are demotivated, they're unlikely to be working to the best of their capabilities. Idle time. If you have an idle time variance, your staff are not working to their full capacity whilst in the production line. Ultimately, this is always going to be an adverse variance because you are paying someone for lost time. You are paying them for doing absolutely nothing. So your idle time then is going to be calculated as the number of idle hours multiplied by your budgeted rate of pay. One good reason for idle time is if you have a machine breakdown, your production staff simply cannot work. They have not got the machinery to be able to do their job. Planning and operational budgets then. What is the difference and why are they important? Well, a planning budget is a change that is known and reacted to. It is a reworked budget. Your operational budget, however, is the difference in the actual results which need investigation. What is the benefit here? Well, it's going to reveal any issues masked by the breakdown, unavoidable once occurred, of course, if any avoidable, over or underspends, and it's going to highlight now how these are going to assist in future periods to be planned and controlled by investigating and resolving any issues. And one final thing that I'm going to end on tonight is fixed overhead variances. So fixed production overhead expenditure variance then, well, this is the difference between the budgeted fixed overhead and the actual cost, and this is after any over or under absorption has been calculated. Fixed overhead production efficiency volume then, if the output generated for the actual number of hours worked is less than expected, we are going to have absorbed less overhead than what we had expected. Our capacity volume variance then, let's consider if our number of machine hours worked differs from the original budget, there's going to be an under or over absorption. If there's more machine hours, that means more fixed overhead absorption. Thus, if there's less machine hours, there's going to be less fixed overhead absorption. I hope that session was useful. It was a very quick breakdown on some of the key points, key theory points that you may need to know for the P1 exam.